When we look at the stock market over the past few years, it has been one of the most wild roller coasters investors have ever experienced. We had the crash of 2020 that led to a massive run going into 2021. Then small caps fell drastically in 2021 going into 2022, while large caps remained elevated. But now going into 2023, basically every stock has fallen over the past year and it has made many people leave the stock market altogether. However, in this video, I want to go back to the basics and share how I personally build a stock portfolio. In order to make it easy to remember, I called these 4 points the 4 no's. So hopefully these will be easy to remember and help you in your investing journey for the future. As we go into these, if you have any questions or things that you want me to cover in future videos, feel free to leave a comment down below and I will do my very best to answer any questions that you have. But I don't want to waste your time, so let's go ahead and dive right in. So when I'm building out a portfolio from scratch, or maybe I'm making big changes to an existing portfolio, I need to know my risk tolerance. I think one of the major benefits of this past year and a half is that everyone's risk tolerance was tested. There were several companies that went down 70, 80, and even 90%, and so it exposed a couple of things for investors. First is how well did they know the company? This is something that I continue to stress on the channel. I have to know the companies that I'm invested in. If I'm not confident, then I will sell out of companies when they fall. And this is exactly what we saw over the past year. Retail investors, in other words, the smaller investors, sold out of companies and many of them left the stock market altogether due to the lack of understanding of companies in their portfolios. And a good way of testing this is to talk with other investors about the companies you are in. There have been times where I've had conversations with people saying how I'm thinking about buying a company, and after a few questions, I realized, man, there are some areas of this company I really need to do more research. So if I was just starting to build a portfolio, I would ask myself, if my portfolio went down a certain percent, would I be okay? Once I figure out what that max number is, I will write it down or type it up and put it somewhere that I can see it often. Then I can start figuring out what kind of stocks that I want to put in my portfolio. For transparency, what I did previously going into 2020 is select stocks without knowing my risk tolerance. And even though I had some great companies, it was still a gut punch when several of them fell drastically because of the crash. So the point is that I could have some of the greatest companies in the world, but because of their volatility, they could fall much more than some of the more stable companies. And over the past year, we saw this with companies that were selling at a premium like Amazon and Tesla. These companies have fantastic business models, but because of where they were trading going into 2022, these stocks were more vulnerable to fall. And this leads to the second no, and that is to know your stocks. Now, I talked about this briefly earlier, but I think there are a couple of really important aspects to understanding the companies you are planning on investing into. First, I need to know the sector that the company is in. You may have heard this called the circle of competence. This is where you know, understand, and can explain certain things but struggle to comprehend other things. And from experience, if you feel like you understand it all, then there will be a rude awakening. This is a big reason why I don't deal with pharmaceutical companies. I just can't understand how their business works. And honestly, there are a lot of vocabulary words that are hard to grasp and really just don't interest me. So I personally look for companies that are in sectors that I understand or that I use on a regular basis. Now, this doesn't mean that I can't learn another sector, but I need to recognize that until I understand that sector, I really don't understand the company. But the second thing that I think is just as important as knowing the sector is knowing how the company operates. This could be from just understanding the management team to seeing if the company is vertically integrated, where basically they don't need to rely on other companies for their success. When I am a shareholder of a company, I have part ownership of that company. And if I were an owner of any business, I would want to know exactly how the company runs. I know the roles of the management team. I know exactly what is talked about during the conference call and quarterly reports. I know where the cash is going and how it's being used. These are major reasons why looking at the balance sheet, income statements, and cash flow statements are so important. And this is a big difference from simply just knowing the product. A good personal example is carparts.com, which is a company I've bought over the last 6 months. I don't know how every single part is made, but I know how the company takes their parts and sends them to customers. The last thing that I want to mention about knowing stocks is that I should be able to keep up with the stocks that I'm invested in. There have been times in the past where companies have had lawsuits, and if I wasn't prepared to know exactly what they're talking about, then I could have made an investing decision based off of emotions. So I have to ask myself, will I be be able to understand what is actually being talked about. And a good way for me to see if I understand the company well enough to invest is look at the previous news releases and then ask questions to myself and see if I'll be able to answer them. But another thing to consider is that it is one thing to understand news of one company, and it is another thing to keep up with the news of several companies, which leads to the third point, and that is to know your limit. There is always a debate about how many stocks someone should have in a portfolio, and my honest response is at the most, I will have as many stocks that I can keep up with, because the reality is that if I can't keep up with what is going on in each company, then I'm putting myself at more risk of missing some key news. So for me, I ask myself, if each stock came out with at least one news or filing each day, would I be able to keep up? That gives me a good indicator of how many stocks I can handle. And this can vary depending on what stocks I'm in. There are some companies where their news is just like reading a children's book. You could go through it in 2 minutes and be done. But for some other companies that have more complex business models, it may take 15 to 30 minutes to grasp what exactly is going on. So if I have more stocks in my portfolio with complex business models, then I may not have as many so I can keep up with everything that is going on with these companies. And in the beginning, when I wanted to own those kinds of companies, but I also wanted more diversification, I threw the rest of my money into an index fund. This helped me significantly in my investing journey. The last point for building a portfolio is to know the market that you're in. Now, I know that there are people that say no matter the market, you should be buying stocks. And I would agree with that. My only caveat is that I'm buying companies that are undervalued relative to the overall market. So the first question that I would ask is, what kind of market am I in? The options I use are spiked market, where every stock is at its all-time highs, bullish market, where the market has trended upward for a good amount of time, neutral market, where it feels like we have been at a standstill, bearish market, where we have trended down, or crash market, where fundamentals and valuation doesn't matter. And the reason this is so important is because it helps me determine what kind of stocks I want to buy. For example, when you look at the indices, we are in between a bearish market and a crash. What this means for me is that more than likely there are plenty of companies that are undervalued, and this is certainly the case. However, if we were in a spiked market where everything is at or near all-time highs, then companies may not actually be undervalued. So I'll look for companies that have a fair valuation, because if stocks continue to go up, then the company has greater potential. But if the market moves in the opposite direction, they won't likely fall as much. And when I look at a company like Amazon, this is a major reason why I'm not a buyer yet. I believe that the company is around a fair valuation, whereas several other companies are significantly undervalued. It's not the fact that Amazon is a bad company, because I believe it is one of the best companies in the entire stock market, but the valuation in comparison to other companies just doesn't compare yet. However, if Amazon was at this price in a neutral or bullish market, then I would definitely be a buyer. And this is why understanding the market is so important for building a portfolio. When I know the market we are in, I can determine what my price targets are to start investing. If I don't have an entrance point, then I become vulnerable for emotions to get in the way, and I either miss a great opportunity or I buy out of FOMO. So once again, the 4 no's I use to build a portfolio are to know your risk tolerance, know your stocks, know your limit, and know your market. Hope you all enjoyed this video, and I'll see you in the next one.